What's up, everybody? Welcome to my live stream. Full disclosure, it's been about 2 years since I did my last live stream, and even then, I only did a few. So give me some grace in case I mess up. I'm going to try my best, and it's going to be fun. I think it's really important to start doing these because I want to talk about what's happening in the housing market and right now with mortgage interest rates, and I want to do it in real time. So if you are looking at this live and you have any questions, just put them in the chat. I will try to get to them if I can understand how. And if you're watching the replay, then put them in the comments and I will definitely get to them. I do have a guest coming on tonight, a mortgage lender, but he is running a little late because he's in Georgia and apparently there's a tornado watch. So he's in a bit of traffic. So as soon as he gets here, I'll have him on. But in the meantime, I have a couple articles I want to go over with him and with you guys. So we're going to get to it. And as soon as he comes in, I'll let him on. So I'm going to share my screen. Give me a second. Okay. Here's how far mortgage rates could drop before the end of 2024. As we all know, what happened last week. So let's read a little bit of it, then I'm going to talk about it. And like I said, if you have any questions, just ask and I'll bring you on. The Federal Reserve's 50 basis point rate cut from September 18th has started to push mortgage interest rates down, bringing a glimmer of hope to potential buyers. With 2 more Fed meetings scheduled before the end of 2024, we could see rates continue to fall. Let's hope so. Experts are weighing in on how low mortgage rates might go, and their predictions might surprise you. Some see rates dropping to the mid 5% range. I think it's ambitious, while others are even more optimistic. But factors such as inflation and government debt could impact those forecasts. Oh, Christina. Hi, Christina. I'm on my own. If you're eyeing a home, the question becomes, should you buy now or wait for lower rates? And I think that's a question that everybody's asking themselves with all this news. So let's see what they think is going to happen. Here's how far mortgage rates could drop before the end of 2024. Debbie Calixto, sales manager at Loan Depot, offers a cautiously optimistic view of where mortgage rates could head before 2025. While we'll likely see a modest improvement in mortgage rates following the Fed's decision on the 18th, future movement will depend on economic data in the coming weeks. Okay, well, we know that. Calixto predicts the Fed might cut rates by another 50 to 75 basis points by year end, potentially bringing mortgage rates down to the mid 5% range. I think that that's kind of ambitious, to be honest. Mid 5%. I mean, it'd be nice, but I don't know if that's going to happen that fast. By the end of the year, it's only the next couple months. All right, let's continue. Josh Green, a mortgage loan officer at Barrett Financial Group, is bullish on rate cuts. Okay, so more bullish. If we're talking about a conventional 30-year fix with 25% down and a 740 credit score, I'd say we'll hit around 5.5% to 5.75% by the end of 2024, Green says. So once again, he also thinks we're going to be in the mid 5s by the end of this year. I don't know. I mean, I don't know if you guys think that that's ambitious. I think it sounds ambitious. Green believes rates will continue to drop as we enter 2025, barring unexpected inflation spikes. Looking further ahead, Dean Rathbun, a mortgage loan officer at United American Mortgage Corporation, paints an even brighter picture. We're looking at rates to possibly be in the high 4s to low 5s by 2025, Rathbun says. This could be a game changer for new buyers and recent home buyers looking to refinance. Okay, so he's saying that we could be in the high 4s to low 5s by 2025. By 2025? So that's still in the next 3 months. I think that that sounds super ambitious and really extreme. I haven't heard any of the people I'm working with, the mortgage lenders that I see on a daily basis, other agents that I talk to. We had our sales meeting today. I haven't seen anybody say that they think that rates will be in the high 4s by the end of the year. I think that would be really ambitious. And I mean, anything's possible. I mean, look what happened during the pandemic. They crushed rates like pretty fast, but let's see. High 4s is great. Yes. So Some people are coming on. 5 is possible. Yes, 5 high 4s would be great. All right, I can't see, so I'm going to have to do that. Christina, I'm not buying high 4s. 5.5% is the lowest I've heard. So me too. That's what I'm saying. Same here. I have not heard anything about the 4s. I mean, I think that that's possible in the next couple years, depending on what happens with the economy and with the election. But I'm not buying high 4s at all. Thanks, Christina, for chiming in. We have another one of my friends, Kevin Grollig, another great realtor that I know. Mid 5s or lower sounds really bullish. Okay, so these are other realtors that are coming on and they're agreeing with me that it does sound bullish. But you know what? We can be wrong. So let's keep going. Let's look at the pros and cons of waiting for another rate drop. I got to show one more comment. Should I wait until after the election? There's potential. Well, that is true. Depending on who wins the election, every 4 years, people say this, that there is potential for turmoil in the market. My experience, I've been a realtor for 21 years, is that people get very anxious before the elections, but not a lot really changes. This election, I think, is a little special, but we'll see. I think that it's more economy based than who wins the presidential election. Okay, let's continue on the article. Pros and cons of waiting for another rate drop. Even with rates drops on the horizon, waiting might not be the best move for home buyers. Traditionally, when rates drop, sales activity picks up and therefore prices become higher, Rathbun says. He tells his clients it's often better to buy with a slightly higher interest rate today because refinancing is possible later. Okay, so if you guys watch my videos, you know that I have a lot of thoughts about this whole like date the rate, marry the house. Yes, sure. It is possible that you could refinance later. And especially right now, if you did buy in the last 2 years at the 7%, you should probably be talking to your lender about possibly refinancing it and the pros and cons of that, how much it'll cost you. But I don't think that you should that prices will necessarily always go up when rates go down. That's just not a given. Okay, let's keep. I'm just going to put some of these comments on. I'm buying 5s. I agree with you, Eli. I think the 5s. I think the 5s is realistic. High 5s, in my opinion, not necessarily the low 5s, but let's see what else they're going to say. All right, your decision ultimately depends on your circumstances to determine which makes the most sense and may help to weigh these pros and cons. Pros of waiting, possibility of lower monthly payments if rates fall, potential for lower finance costs. Okay, that's nothing new. Cons of waiting, risks of higher home prices due to increased demand, more competition from other buyers entering the market, missing out and building equity sooner, potential refinancing costs if you buy now and refinance later. I think they're not saying that different things, but the risk of the higher home prices due to increased demand, that's definitely true. But you also have to think that if rates do get low enough, especially if they get into the 4s, which I don't think they will do, I think more sellers will come on the market because they will be more open to putting their house on the market and then buying and not having to give up this really low rate like they are right now to a much higher rate. So you may have more buyers, but you also may have more sellers. So that could even itself out. The good news is my guest is here, so I'm not alone anymore. So I am going to bring him on. I see you smiling. All right, let me stop that. All right, Kevin. I can breathe now. This is Kevin Jefferson. He's a mortgage loan officer. It's been in the real estate industry for 20 years, based in Georgia, where I guess they have a tornado watch, unless he was lying. And he can lend in 40.
No, I'm not at all.
I'm not done. His YouTube channel is Kevin Jefferson, the People's Lender. Welcome and thank you, because I was very nervous being by myself.
You were doing an excellent job.
I'm glad you're here. Okay, I'm going to get back to some of these articles. But actually, did you hear anything we were talking about? Anything that article was saying?
I heard them talking about interest rates. I saw somebody post that they would get back in when it got to 5%, and then they were talking about more houses coming on the market.
Yeah,
increasing inventory. Yep, I heard so.
So, you know, actually what I love for you to do, because a lot of people, and there's no fault to anybody, but a lot of people think like they hear the Fed cut rates and instantly that means that mortgage interest rates are going to go down because of the same thing. And they're not. So could you just like explain briefly like what the difference is and how one affects the other, just for people that don't know?
Right. How's my sound? I'm sorry.
I hear you good. What about you guys that are
Good, good, good.
Kevin,
So
Christian? Yeah.
when I call him Uncle Jerome, Jerome Powell comes out and he gives us a determination whether they're going to leave rates the way they are, or they're going to cut rates. For you and I, it spurs people wanting to get into the real estate market in terms of buying because they heard rates were cut. But it doesn't affect mortgage interest rates. I'll explain. When Jerome Powell and the Federal Reserve says, hey, we're going to cut interest rates, it's pertaining to personal loans, student loan debt, car payments, credit cards, home equity lines of credit in some instances, right? It affects those things because that money comes from the Federal Reserve. Mortgage interest rates are based off of the 5-year and the 10-year Treasury bond. So it doesn't have a direct effect on us. So example of what happened right now. When rates were cut last week, that was the first time it was done since 2020. So it's been 4 years since we saw a rate cut. What we did was they mentioned that they were going to be potentially cutting rates, and the jobs report and inflation reports came out well when he last came out in July. So mortgage companies hedged that, hey, there's going to be rate cuts in the next meeting or the last meeting of the year, right? So we started not drastically, incrementally dropping rates because the market reacted to the improvement in the jobs and inflation. So we saw mortgage rates dropping over the last month and a half, 2 months. So when he reduced rates and all of the news media were talking about, oh, rates were cut 0.5%, my phone started ringing. I was getting text messages, and I sent the client a screenshot that mortgage rates actually went up.
Right. That actually, I noticed that as well. So that's what, when they say they already baked in, that's what they're talking about, right?
Yep.
Like once there's an indication that the Fed's going to lower rates, all the lenders out there bake that in and start already lowering their rates even before it happens. Is that what you're saying, basically?
Yep, before it happens. So what does it do for you as consumers? It may be a good time to check into refinancing that high car loan that you got a couple months ago. Maybe it's a good time to take a look at refinancing your student loan debt. Maybe if you got a personal loan, maybe it's a good opportunity to refinance that loan, right? To get lower rates. What does that do by getting lower rates? It gives you more disposable income, which could potentially help you qualify for more house.
Right.
Okay, so you don't have any of those loans to refinance. Well, a lot of people do, and the economy will start to see people doing things and getting into the market, and then we should see a residual effect in the next couple of weeks, right? Like today, I mean, I've been in continuing education classes all day, but I saw the market get slightly worse twice today. What does that mean? So let's say, example, we woke up this morning and FHA rates were 6%. And the markets, and to get that 6% interest rate, it costs you, let's say, $1,000. However, the market gets worse by an eighth, and all of a sudden that $1,000 goes up to, let's say, $1,250. That's what it means, right? It doesn't necessarily mean, oh, the interest rate went up an eighth, and it doesn't
Right.
mean interest rates went down an eighth. It costs a little bit more to get that rate. Well, let's use the example in reverse. Let's say the market declined an eighth. Then that means, okay, that same $1,000 that you were going to use in the morning got you to 6%, but now there's enough margin in that to get you down to maybe 5.75 or 5.875. So when you, that doesn't necessarily mean that it's the actual physical rate is dropping, because there's other indications. Your credit score. where you're located, how much your loan is. So lower size loan amounts typically have higher interest rates. Lower credit scores typically have, higher interest rates. If you're above 640 and you above 250 in terms of price point, you're going to get a better rate than somebody that's at 600 or 620 and a 250, just because the loan amount and the sizes.
Right.
Okay.
But if all things were like, if all things being equal, right, if we're talking apples to apples as far as the customer, do you think that rates are going to continue to go down like these people in the article are?
I think they will. They'll gradually begin to go down some. Not that I'm being political, so I'm not going to be political at all, right? But what I've seen and what I've studied, because I study my craft, no matter who's the president, over the course of the last 8 elections, interest rates have increased, and so have housing prices, other than 2008 when the market crashed. And then other than when President Trump was elected as president, rates went down and stayed down some, but a portion of that was because of the pandemic too. So, right. It's just a matter of who gets in. So, and,
but these guys are even talking about by the end of this year.
Yeah, we'll see. I think that we'll see rates in the mid to low 5s.
You do?
I do. I think we'll see it. You can, and when I say I think we'll see it, I think we will see it at par. So when I say par, that means you're paying close to nothing for that rate. Right now, you could get to the mid to low 5s buying it down and spending. But, if you bring a buyer and they're looking at FHA loans and they, 640 credit score, let's say the house is 350, then they may be able to get, by December, it's possible they could get a 5.5 interest rate. So I think we'll see it because the economy is getting better. The factors that play into the economy getting better are getting better. Whether we have in our mind that it's where it was when it was 3%, that's a different story. I know that now, and I'm not paying $6 for eggs right now, so I'm happy.
Yeah. I agree. I don't think it's going to get down to the pandemic interest rates, the 2.5%, 3%. I mean, I haven't heard anybody think that or say that. I have another article from realtor.com that some more predictions. Let me bring that one on and let's take a look at it. Okay. So this is experts predict where mortgage rates are headed in 2025 as the Fed cuts rates. Can you hear that okay? Yeah?
Yep, I can hear it.
I mean, can you see it okay? Sorry.
I can see it, I mean.
Okay, so this is Lance Lambert, who I absolutely love. He's one of my favorite writers of different articles. He's a data collector. He's super smart. So he says, to see where experts predict the 30-year fixed mortgage rate might go over the next 18 months, Realtor.com rounded up the quarterly mortgage rate forecast from 3 major firms, the Mortgage Bankers Association, Fannie Mae, and Wells Fargo. By Q4 2025, Fannie Mae expects the 30-year fixed mortgage rate will average out at 6.2%. The MBA expects 6%, and Wells Fargo forecasts 5.9%. So these are much higher than the last article. And here's the breakdown, starting with now the fourth quarter of 2024 into the first, second, third, and fourth quarters of next year. And can you guys see this okay? They're all starting at the mid 6s to the low 6s and ending a year from now at the high 5s to the mid 5s. So none of them are saying 5 to 5.5, and none of them are close to 4%. And I'm assuming when they talk about the average 30-year fixed mortgage rate, they're talking apples to apples, because obviously you can buy points and you can do that just like you were talking about, Kevin. But right. I think they're just talking about, good credit score, 20% down, apples to apples type of thing. What would the mortgage interest rate think? You're the lender, I'm not, but I'm assuming that's what they talk about in these articles.
Yeah, so they do. And the other thing is, Caryn, is that like when they mention Fannie Mae, that's strictly conventional financing, right? So conventional finance loans typically has a higher interest rate than FHA loans and VA. So they have a higher interest rate than government loans. A lot of times when you see these loans and those quotes, you're right. There's typically 20% down, 740 credit score, which all people don't have. That's why it says it starts at around. But just kind of play it by ear. They will. They've all got different data, and we were just in a class and we were talking about how it's before you could kind of gauge where rates were going to go. Not anybody had a crystal ball, but you could kind of gauge what you would see after or before an election or after a certain season or immediately after Jerome Powell mentions or whoever's in charge of the Federal Reserve mentions rates dropping, you could see that effect. Well, it's been a week and I haven't seen a huge decline in rates. I think we'll see it over time, but beforehand, we saw significant drops. Like we're still, even though we haven't seen a huge drop in the last week or so, we're still at a 23 or 24 month low. So, rates are they're lower than what they were back in February of 2023. So we're looking at a great opportunity for people to get into the market. Problem is, example, the person who said they were going to wait until they get in the fives, studies show that people say that if rates get to 5.5 points, 5.5 interest rate, they're going to get back in the market. 4.5 million people. The inventory won't come on the market fast enough, right? So what does that do? Yes, rates are lower, but now we have pent up competition again. And we could see housing prices increase along with two other factors that we hardly even talk about: property tax increases and homeowners insurance. So all of those things play a part into the actual market and your affordability. So if you have the ability to refinance some of those things to free up some capital, I would in advance. I would take advantage of the rates dropping on those things, for personal debt, credit cards and things and such. So you can, when you go to get pre-qualified with the lender, you're able to purchase more home because 9 times out of 10, you're going to need it.
So we have a question from Eli. What are the interest rates now for a 30-year? What are you seeing today? And I know, like we said, it can change, but just assuming a good credit score and I guess 20% down.
So good credit score, 20% down. You're probably looking at low sixes for conventional financing. For the government-backed loans, you're probably looking at 5.75, 5.5. It just kind of all depends.
Yeah. And yep. Jumbo low sixes?
Jumbo, I would say jumbo would probably be in the mid sixes. Jumbo, what people don't understand, even though the loan size is bigger, jumbo loans interest rates are typically higher than regular conventional because of the size of the loan and the risk, even though they may put down 20%. Mm-hmm. Yep. And that's the 30-year. Of course, when you look into doing 25 and 20 and 15, those rates are adjusted a little bit. But yeah, for the 30s, you're probably looking at in the mid sixes, low to mid sixes. And with FHA, with the government stuff, FHA, USDA, and VA financing, with decent credit, you're probably looking at 5.75 to 6%.
And you think that's going to be through the end of this year, not next year?
Yeah, I think it'll be through the end of this year, and we don't know the market. The market cycles.
I know. I understand.
But just off of what we're seeing, I think we'll see rates drop some, and I really think that the fourth quarter is going to be the strongest quarter for a lot of people in our industry.
Yeah, I mean, as we both know, real estate is so localized. Like what is happening in Georgia, where you are, is very different than where I am, right outside of DC in Montgomery County, Maryland, which is very different from what's happening in the Midwest and the West Coast. It's all very localized. I do agree with you though that and with the article that if rates get to a certain point, and I personally think that is going to be closer to 5, it will release a lot of these sellers that are in this locked in effect that refinance during the pandemic and don't want to lose those super low 3% mortgage interest rates to then go buy something else. And if it gets to close to 5, it gets in the 4s for sure. I don't think it's going to get in the 4s. But if it gets close to 5, I think some of those people will be like, okay, I'll sell now because it's not that big a difference as opposed to 3% to 7%.
Just 7%. Yep.
Yeah.
I mean, earlier this year, I was quoting people in FHA. It was almost close to 8%. Like
Crazy.
I was like, this is getting crazy. But the crazy part is, Caryn, when I got into the industry, rates had just went from 8 to 7. And then when it went to 6, people thought they were stealing money because at that point, that was the lowest rates had been.
I remember.
Yeah.
I remember when I moved back to Maryland from California, which was 18 years ago. My son just turned 18. We got a 6%, and I was so excited. I was like, "Oh, that's awesome!" And then now, this year and last year, when they were just in the 6s, and everyone's crying about it, and I was too because I work in this business, and you're so used to the 4s and the 5s, and for a couple years there, the 2s and the 3s, that it is a lot more money, and it does, make housing much more unaffordable. And everything's more expensive right now. Groceries, gas, everything is. So then you add housing on top of that. And like you said, good points, your home insurance, your property taxes, all of your home expenses, it becomes a lot,
Right.
it becomes harder and harder to be able to afford a home,
It is.
it makes me sad. All right. So let's get back to, let me finish this, or let me get back on here. I don't know why I got off of it. Okay. So just to finish it out. So while rates are expected to bounce around a bit, we expect them to, I read this. We expect them to be in the low 6% range by year's end, says Realtor.com chief economist Danielle Hale. The Realtor.com forecast also anticipates that mortgage rates will move lower, perhaps into the upper 5% range by the end of 2025. And then they just go on to say they hit a high of 7.79% in October 20. So it's only a year ago. There was almost 8%.
Right.
I mean, I think the rest is just going to be about how it affects affordability, which is what we're already talking about.
Right.
I just there's so much talk, and I hate it when people really get their hopes up when they hear the Fed's cutting rates and think there's going to be an automatic drop and everything's going to be like it was a couple of years ago. And it's not. Do you get that a lot with your clients where they start calling you like, okay, we're going to be like where we were, and you have to give them the realistic news?
Yeah, you have you have those conversations, with your clients. And even when they go to refinance, sometimes what they're going to save is not as significant as they think. So when they hear that rates drop, they think that they're going to save $500-$600 a month in their mortgage. And truth be told, it depends on your loan size. If you're looking at $500,000 house and rates drop 0.5%, unless you really need it, it may not make sense to do, right? When it gets to about 1 percentage point, so if you were at a 7% and rates drop for your loan at 6%, then it may make sense for you to refinance, especially if it's conventional or you have 20% equity in your property, because then you're dropping the rate as well as potentially getting rid of mortgage insurance. Well, guess what? Let's say it only equates to $300. That's a bill. Like, it's $300
100%.
is a lot of money to save, and if you look at it over the grand scheme of things, it's $3,600 a month. And if rates get better, 210 days after you've refinanced, and let's say 210 days from then, let's say it's March or April when you refinance, and rates are better, and you save another $200, then that's $500 you save total. You can refinance again. But I would not wait and try to time the market because none of us know when the market is going to change. And I just kind of tell people, if I talk to you now and you can save $300 a month and you wait 6 months, that's $1,800 that you'll never be able to save. Even though you'll be able to refinance and have a lower rate in 6 months, you still have paid out that additional $1,800 that you could have been saving all along, which could have paid down some debt or discretionary debt. On top of, if you waited 6 months and rates drop, you would then be able to refinance and continue going. So people are, every little bit counts. I know there's times that I'm like, man, I need $200 more for this. If you can figure out how to save it, then it's something you can put towards extra debt. You can even save that $200 a month. And this is a trick, right? I think it's a trick. Let's say you refinance and you save $200. You can take that same payment that you were paying and pay the extra $200 towards your principal and help you save more interest over a course of time and pay down your house faster. So that if even if it's just $200, you can have the same payment that you used to paying, pay your normal mortgage payment or whatever it is at the time when you drop. Let's say it's $3,000, and you take that extra $200, call your mortgage service and say, hey, I'd like to apply this $200 to principal, and it'll knock down you being able to pay faster and pay off your home faster. So it's a way to utilize that money that you already used to spending. And if you get in a jam where you can no longer pay that extra $200 a month, then you're still saving it. So,
Yeah.
those are ways to save money and pay your home off faster as well.
I did that. I'm so happy you said that. I did that when I refinanced during the pandemic. And I was like, wow, my mortgage payment is so cheap now. Why don't I just keep it the same? I was used to it and add that extra $300, but you have to allocate it towards principal, like you said. Otherwise, it doesn't help you at all. But if you
Right.
allocate it towards principal, it shortens your loan. I don't know if I'm right. You'll have to correct me on this, but I heard that if it equals one entire mortgage payment extra a year, it shortens it by like 10 years or something in the scheme of things. I mean, I may be making that up. Is that true?
No, you're not. I mean, you're close. So if you have a 30-year mortgage and you pay one extra payment a year, it takes that 30-year mortgage to 22.6 years. I mean, yeah, 22.6 years. So almost 10 years you save off of it, right? And someone said, well, how is that? That's because the first 10 to 12 years, majority of your mortgage payment, your principal interest is going to the interest. So if you pay extra, and you look at the amortization schedule that you have, it pays down on that principal amount. So over the course of time, you're paying less into interest and more of it because you're lowering the principal balance.
So smart. It's so smart. And I don't think people realize that. I'm so happy you brought that up because it's a great time to refinance right now. Especially if you bought in the last couple of years, obviously,
right.
Because you can save that money. But if you are used to that payment and you're okay with it, to then allocate that extra money that you save by refinancing to your principal will save you in the long run. And what a gift that is to yourself. You know what I'm saying? It's so smart. I'm so glad you brought that up.
Yep.
My question for you is, if there's a buyer who's thinking about buying, should they lock now or should they wait? And can you lock earlier, or like, how does that work?
So if you have new construction, and let's say it's not with the builder, you can probably do something called lock and shop. I know a lot of mortgage companies brought this back out when rates were getting higher from 2022 to now, 2021, 2022 to now, right? I'm pretty sure some of them are still offering it. You just don't hear much about it because people have gotten used to, okay, this is what it is. This is what the rate is.
Mm-hmm.
But in terms of being able to lock, other than that lock and shop on new construction, you probably can't lock. You can't lock ahead of time simply because it costs every day that the lender locks the loan. Well, that's the cost of doing business. But if you decide to go with ABC Mortgage Company versus the one you were with, they've lost money on the loan before they even got the loan. So I got a story. So I had a client that was doing a refinance, and we locked in July. It took that long for us to get us documents and do all these different things. It just drug out. So rates started dropping, and they reached out to us and was like, "Hey, is it possible?" This was like literally the day before closing. Like this was last Wednesday, and they were closing on Thursday.
Oh, geez.
They was like, "Hey, can we get a lower interest rate?" And we were like, because I heard interest rates dropped, and I was like, "We can't reprice the loan because you already have extended your time, and we're on a free lock, right?" So they were like, "But rates dropped." I said, "One, you've got a second home, and those rates are not going to be the same as if it was your primary residence. Two, I checked into it, and we couldn't do a reprice just because of the time frame and everything." And then I had a conversation with him. I said, "We can't drop the rate because you want to now and hit your closing date the same way that if rates went up, we can't go back to you and say, 'Hey, rates went up, we got to reprice you.'"
Right.
And I told him, "Hey, for the purposes of why we needed to refinance, that's fine." I said, "In 6 months from now, when you guys are going to be here, we'll price you out. You'll get way better pricing simply because now it'll be a primary residence versus a secondary home, and all of those things change."
Mm-hmm.
So, buyers, I would say get pre-approved. If you're
Right.
thinking of if my biggest thing is apply. People say, "Well, what should I do?" Apply. Because everything that I'm telling you is hypothetical because I have nothing to go off of. But if you apply and see what you need to do, you may have great terms now. You may not have great terms now, but at least okay, this is what I need to do to get in the position where I need to be. Or this is what I need to do if I want to get XYZ rate, right? Okay, I need to make sure that I have my down payment and my closing costs. Okay, this is what it looks like right now. And if I want to buy the rate down a little lower than it is to save the money. And a lot of times people just don't know. Like I have clients, like I got a guy now who wants to put down $200,000 on the house. And I said, let's apply and let's see if that makes sense. And the only reason why I said let's see if it makes sense is because it may make more sense to put down a certain amount for down payment and then use the rest to buy it down because it'll have a greater effect on your loan. Because what people don't understand is that $200,000, it goes as a down payment, but it's not going to have a significant change because it's spread out over 360 months. So when you look at $200,000 over 360 months, that's not a lot of money.
Right.
And it doesn't affect it. But if we put down where we need to be in terms of your minimum down payment requirement and wherever we can buy the rate down to without it being a high cost situation, then we could potentially get you closer to your monthly payment. Even if you wanted to go a little further and not many people talk about it, we could potentially see after you buy the home, you take the remaining money and you get with your lender or the servicer, and we see if we can do something called a recast, where you take that chunk of money and put it towards the principal, and it then could help you. It won't change your interest rate, but it could change what your monthly payment is because you paid it down some.
So let me ask you a couple questions. How long do you have to wait after closing before you can refi?
210 days from the date that you purchased the home.
From the date that you closed on the home, not that you wrote the sales contract, so you closed on the home, 210 days later, you can then refi for that home.
Yep, you can refinance. And what they typically want you to do is have made 6 on-time payments. Where that other 30 days comes in is because you typically have a free month between the time you close to your first mortgage payment.
Okay. And then my next question, because of what you were talking about, is it's really good advice to say apply now so you can see kind of where you stand. But what are those best terms? Like, what is the best credit score to get the best interest rate? And if you come up short, are there ways to fix it in
Right.
time to then buy a house, like not in 10 years, but in a reasonable amount of time.
Right. Realistically, 740. Anything
Okay.
above a 740 doesn't really change your terms, right? But then I also tell buyers, like, it's not easy to get a 740 credit score.
So if you
So
didn't have one, how could you improve it, without waiting too long?
look at your debt, your credit card debt. Are your credit cards utilization high? If so, paying those down. Obviously, not having any late payments. And when we say pay it down, so the one thing people get confused with is, well, I pay my payment on time every month, and that's good, but what you need to do is keep your balance low. And then some people say, well, I pay it off in full. That's cool, but every time it reports, it's going to report with the higher balance. And even though you pay it off, if you use it back up again, it'll never show a consistency of you having low balances, which then helps you optimize your scoring potential. So if you look at a credit card where someone has a balance of $5,000 and their limit is 7, versus somebody who has 7,000 and their limit is 700, that person with the 700 balance is going to score more points, even though both of them have the same balance. They have the same limit, and let's say they both pay on time. They like to see, okay, this person isn't over leveraged, and this person is. Meaning, when it comes to credit cards, they don't want to see you over a 30% utilization. If you can be 10 and below, that's even better to help you optimize. But it has to be, it doesn't happen in just 1 month. It could, depending on what you have in your credit, but it typically is over a course of time when you see it. So when I see people who have high credit scores, they have very little debt and their credit card balances are low. They have enough debt for it to report, and then they're typically seasoned. I won't say older, they're seasoned. Uh,
Come on.
they're seasoned. And it also depends on how long you've had credit.
Yes.
So all of those things matter.
So
Go ahead.
sorry, I have a question for you before I forget, because I am old. Would it be better to have a credit card that goes up to, let's say, $5,000 and you max it out, but you pay it off every month, or you come close to it, pay it off every month to zero? Or should you apply for a higher loan limit, right? Which is a hard pull. And then let's say you get a $10,000, right? Credit on your credit card, and you still only go to $4,000 to $5,000 a month and pay it off. Would that be better then, to get the highest amount of credit you possibly can?
It could. Again, it all depends on what your credit profile looks like in advance. So, like, if it's your first credit card, then if you have a $10,000 limit and a $4,000 balance, you're at 40% utilization, which is still over that 30% threshold.
Gotcha.
Now, what I have seen people do is, and it's the least expensive thing to do. Let's say you've been with a credit card company for 5 years and you're never late, but you've never had a increase in your limit. I would request a limit increase. So let's say you had a $5,000 card, the balance is $4,000. Let's say the balance is $3,000, and you ask for a $5,000 limit increase that takes you to 10. Because the increase of your utilization goes down because your credit available goes up, then that helps increase your score as well. And then you're not paying the bill down $3,000, but you're getting an increase. That helps as well.
Yeah, I think that's what I was trying to say. I don't think
Okay, all right.
No, because I was actually thinking about one of my clients who had that similar situation. She was like, I pay off my credit card every month. And just listening to you talk, I'm wondering if it's not so much that she doesn't pay it off every month, it's maybe the amount of credit she has available on that card that you're saying, because it doesn't have time to really go to zero because she keeps, using it.
Charging it up.
Right?
So example, when you have credit cards, you need to know 2 dates: the due date and the statement date. So she uses her credit cards up every month. If she pays it by the statement date, they don't report. If she pays it off by the statement date, that $4,000 that she might have used that month doesn't report because the statement, she's paid it before the statement is generated. Because think about, you charge, then the statement's generated with the balance, and then the due date is when you have to pay it, so it's not late.
Right.
If she uses her credit card and and let's say her statement date is the 26th, but she pays it off on the 24th, two things happen. That $4,000 she charged doesn't get reported because she's paid it off. And then when she doesn't get charged interest because she paid it before it was actually due.
Right. So
Yep.
smart. I'm so glad you brought that stuff up.
So
because,
that helps with the score as well.
right. And
Yep.
these are little things that it's just a matter of knowing them and being conscious about timing and stuff like that you can do right now, and get yourself in the best possible situation to get the best mortgage interest rate, to get the cheapest monthly payment. And that's what it's all about in the end. I mean, I think it's just super smart. What about for self-employed borrowers? Because back in the day, remember, I'm old, it used to be like stated income. You just told them how much money you make. Because I'm a realtor, I'm self-employed. You just told them how much money you make and they just gave you a loan. That was like pre, 2008. Then 2008 happened and it was like, no, you have to be a W-2 or you'll never get a loan. Like it just was like, it went way the other way. What's happening now? Like, I know that, some of my lenders saying, well, we've, eased up a little bit. We have a little more programs. What do you have?
So there's a whole different space out there now that's been developed called non-QM, non-qualifying mortgages, which doesn't mean you don't qualify for a mortgage. It's just not purchased by Fannie Mae, Freddie Mac, or Ginnie Mae, or anybody like that. We have loans called bank statement loans. Self-employed borrower who operates their business, has been in business most of the time at least a year. They prefer two, but they get deposits in their account frequently, at least once a month. Occasionally, depends on if it's every other month. What we do is we'll take 12 months of those bank statements. We'll look at the deposits that go in that are business deposits, not your husband and wife depositing their check into your business account, but actual business deposits. And we give you an average of what that income is. Typically on bank statement loans, the better the credit, the better the terms. So once we get that income, then we look at, okay, has it been in business for 12 months? And what is the liabilities? So if you have a high, like for instance, as a real estate agent, you guys have overhead, but you don't have the same overhead as like a retail store.
Right.
So you'd be able to utilize more of the income deposits because you can get a letter from your CPA or accountant to say, hey, Caryn only uses 15% of her income for expenses. And then
only that were true.
Business expenses, right?
But that's better.
Yeah, business expenses. So we have the bank statement loans, which as low as 10% down, as high as 20%, 25%, depending on your credit as well. We have profit and loss statement loans where you get a profit and loss statement from your CPA who can stamp it and sign their name to it. And it'll tell us what your profit and loss is for your business, and we can utilize that for your income. We have the P&L bank statement loans. We have some loans for like for instance, do you own your company?
So yeah, I mean, like I said, I'm a real estate agent, so I'm an independent contractor, but I have a business, Gardiner Inc., and that everything falls under my business. I have an S corp.
Got you. So are you under Keller Williams or anybody?
No, I work for Compass. It's another.
Okay. So Compass issues S corporation a 1099.
They actually don't, like old brokerage did. They would give us 1099 because it is an S corp. It's not a 1099. It's a different type of statement. I don't remember what it's called. I just give them all to my accountant and they tell me how much money I owe.
So let's say the person is they're a realtor. They get a 1099 from their company.
Yeah.
We've got where we can utilize 1099. Like, so for self-employed borrowers, there are different programs out there. I just want to make sure I preference that you're going to have a larger down payment. It's not going to be an FHA. If you're going that route with lease documentation, it's not going to be FHA, VA, USDA, or conventional financing. You're
Okay.
typically minimally is going to have to put down at least 10%, possibly 20. Your interest rate is going to be higher because it's a little bit more risk, but you don't, whether it's 10% or 20%, you don't have mortgage insurance. So sometimes that offsets it as well. Typically, those loans don't have prepayment penalties. So once you get those 2 years of tax returns in line where you need to be, you can refinance out and get you an FHA loan or a USDA loan or a VA loan or conventional. So there's options out there for them. And then there's something called asset depletion. If you're an entrepreneur and let's say, Caryn, you say, you know what, I'm ready to sell the business, and you sold the business, we can look at what you sold the business for, and we can give you a percentage of that as income, if it's distributed properly over time, and we can get you an asset depletion loan based off what your assets are. Because I'm pretty sure you're not going to have the money just sitting in the bank. It could potentially be in other investments. So
Right.
we have options like that. I had an entrepreneur who sold their business and wanted to buy a house, and instead of paying cash for it, they just used the asset depletion loan and got decent terms on that as well.
Yeah. I mean, there's so many different programs out there. I don't honestly know how you guys keep track of them all. And a lot of them I know are income related or credit score related, or you've got different, programs and grants and government and conventional and jumbo. I mean, it's a lot. And as a real estate agent, I'm always so grateful to my lenders like you that are so knowledgeable about the different programs that can fit the different individuals in their specific situation and circumstance, because everybody's different.
Right.
Everybody's different and they all have their independent needs and what they want to do and what they want to buy and what they can afford.
Right.
And I just, it hurts me when I see people, not that work with me or with you, but I see stories that people tell me they see a house and they fell in love with the house and they want to buy the house and they can't afford it because they didn't get pre-qualified beforehand. And they didn't work with a professional like you who knows what they're talking about. They just read some internet rates, which aren't always the real rates, right?
Right.
And think, oh my gosh, look, the internet's saying I can get a mortgage interest rate for 5%, so I can afford this house. And it's not as simple as that. And I just hope everybody who does want to buy a house can really educate themselves to get the most information possible to get the best deal possible.
Right. And what you have to understand is even the information that I'm giving now that I give on my channel is not a one size fits all. That's
Right.
it's facts, but it's based off a certain criteria as well. So the only way, example, I always give people example. If my wife and I applied together, our terms are going to be one thing. If she applies alone, her terms is going to be something different. If I apply alone, my terms are going to be different. And it just depends on what you look like collectively. I see situations where they're family members that are, we're starting to see more families conjoin together into one house. And, typically the parents have the better score and less debt, but make the least money. And the kids make more money, but have a little bit more debt. So they help offset each other. So all of those things play a factor into it. And, you can, with FHA, you can get it. If realistically, we can go down to a 550 credit score and get you FHA financing if you have 10% down. Not going to be the greatest terms, but if you have 10% down. If you have a 580 credit score, you can get in with 3.5%. I pre-qualified a young lady who had a 580 credit. They had her and her husband collectively had a 587 credit score, and they got approved. It wasn't a manual underwrite, but you know what was the deciding factor? Because they had reserves in their 401k. meaning after they pay their down payment and closing costs, they had the ability to liquidate some funds if they got into a jam. All of those things play into factors. I got a veteran right now who has a 6-something credit score, but he has to go manual because he just doesn't meet the criteria in terms of desktop underwriting. And the only thing, his DTI is not high, it's just he doesn't have a lot of extra money. So he has to have reserves as well. So when you're getting approved, pre-approved, it's not just, okay, I've got this score, that score. Can you afford it? And,
Right.
I have people call and they've got 700 credit scores, but they make $2,000 a month and they can't afford a house.
And at the end of the day, it's about the banks and their risk, right?
Yep.
Like
Risk.
how risky is this potential borrower?
Yep.
And therefore,
Risk.
how much money do I want to give them based on
Yep.
risk? And so it makes sense if you look at it that way. Like if you have a lot of reserves, there's less risk because they know you have some money. Do you know what I'm saying? But it totally makes sense.
So
This
I
is
get
a great.
Go ahead.
This is a great time. I have one more article: 4 mortgage interest rate myths to know now. So I'm going to pull that up. I think that could be really interesting. I'm sure some of these you'll have an opinion on, as I will. All right, 4 mortgage rate interest rate myths to know now. Can you see this okay?
Yep, I can see it.
Okay. Home buyers and owners looking to refinance finally received a bit of positive news on September 18th. All right, in the February, we know that, since 2020. Anticipating the cut, mortgage lenders started reducing their offers, just like you were talking about, resulting in mortgage rates plunging to their lowest point in 2 years or since September 2022, and they've continued to drop. These drops and the potential for additional reductions in November and December are exciting for home buyers. All right, where's the myths? Okay.
You got to scroll past the calculator.
Yeah, I know. Your little ad. Below will break down 4 of the myths. Okay, let's get down to that. 4 mortgage interest rate myths to know now. Considering entering the home buying market now, ready to apply, don't do this without first knowing the truth behind these 4 popular myths. Mortgage interest rates will fall alongside the Fed. That's what we were talking about at the beginning. Sure, mortgage interest rates can and likely will fall as the federal funds rate does, but they won't fall by precisely the same amount or even at the same time, as some lenders start pricing in presumed rate cuts before they're official. Exactly what you said. You started baking in those cuts even before they did it, right?
Right.
That's why the mortgage interest rates most are seeing listed online this week aren't materially different than what was listed earlier in September. So don't budget for exact reductions solely based on how the Fed acts, as mortgage rates are influenced by more than just that. Okay, we already went through that one. Good. Second one, mortgage interest rates could fall back to where they were. I mean, it's not going to happen. Mortgage interest rates will likely fall in the months ahead, yay, perhaps by a somewhat significant margin, but they are highly unlikely to fall back to where they were in 2020 and 2021 during the height of the pandemic. That's when the economy was different from where it is now and rates were in record lows. Don't count on that happening again, minus a major economic driver. And remember that today's mortgage rates historically are already on the low end. So don't expect them to fall to 3% again. I agree, don't you? I mean, I know we already said this briefly, but I really feel like when the pandemic hit, like nobody really knew what to do. They didn't know how long it was going to last. The government didn't know. And so they just stimulated and just poured money into people's pockets, understandably, because we didn't know what was going to happen. Made money so cheap that people started refinancing and buying houses and everything went crazy. And then look what happened. 2 years later, they're using that same manipulation by raising rates to battle inflation. So unless something really drastic happens again, I don't see that happening. And I'm assuming you agree. Yes?
Yeah, I do agree. That was once in a lifetime, I think, at least for me.
Right. Well, unless we have another pandemic, but I don't think so. You never know. Okay, the mortgage rate you see listed online is the one you'll get. I'm glad they wrote this. It can be smart and addicting to check mortgage rates each day, but it is critical to remember that the one you see listed online on a lender's website isn't necessarily the one you'll be offered. That's because mortgage rates listed online are for those with the cleanest credit histories and the highest credit scores. If you don't have both, you'll be offered a higher rate. But that's not the only caveat. Mortgage rate listings also often have mortgage points and other reductions already accounted for. So the rate you're offered, even with a high credit score, could ultimately be higher if you forego paying those fees and reductions. Read the fine print. What say you, Kevin Jefferson?
Yeah, like they're not going to be the same. A couple of reasons why. One, it might not be the same simply because if you're using some sort of down payment assistance program, which rates are typically higher on those programs, it's not going to be the same as the one that you see. Or again, we talked, those rates we're looking at is with 20% down and 740 credit score. And if you got a 640, you qualify, but you don't get the same benefit as the person with a 740 credit score. So all of those things are going to be different.
And I think they're right that a lot of these internet rate score or rates that they're publicizing have points. And unless you read the fine print, you say, well, this is if you buy 2 points, you buy 1 point, then you'll get this interest rate, right? If you just see 5%, 4.75, whatever it is, without reading the fine print and realize you're actually going to pay for that, right? I mean, that can be really, really misleading.
Right.
All right, let's look at the last one. Mortgage and mortgage refinance rates are the same. Are you a homeowner eager to refinance? See, now is your opportunity to act. You may not be wrong. Just be sure that you're checking the right column online, as mortgage interest rates for purchases and those for refinancing existing loans are not the same. And there could be a 25 basis point difference or more between the two. Make sure to monitor the right rate type then before getting started. So which is higher? Refinance or sale?
Typically, refinances are going to be better.
They'll be better, lower. So those will be the better rates.
Yep, because you already have the house. So you have the ability to refinance, and those things also still depend on if the scores are the same, the equity. But typically, refinance rates are a little bit better than the buying power.
So do you think that some people see these interest rates that are really low for refinancing and automatically assume that they're going to get it when they're buying a house? I could see that happening.
Yeah, I can definitely see that happening. But you could, with 25 basis points, you could get that. It's just going to cost you a little bit more.
Yeah. How much is it generally cost to buy your rate down?
So 1 point is equivalent to 1% of the loan amount. So if it's 1 point on a $200,000 house and you're looking at FHA, it's about $1,930.
And then 1 point is 1/4% interest rate. Is that correct?
1 point typically gets you around 1/4 or 1/8. It just all depends. So if you buy down your rate, if your rate costs you 1 basis point or 1 discount point, that doesn't mean your rate's going to go from a 6% to a 5%. It might just get you from 6 to 5.5 or 5.75.
Right.
So, and that's where people get confused as well. It's so much information out there that is inaccurate or not told properly.
Yeah.
So if any of your listeners, or if you're watching the replay, if you need any advice, I would say make sure you talk to a knowledgeable mortgage professional. You may call somewhere and get a super rate, but if you know your situation is difficult, and let's say it is an online lender, those people are order takers. So they don't necessarily have to think out your scenario, or do they typically have the ability to? Because they get so many leads, they don't have to worry about where's my next lead coming from. Versus your local lender or someone that your real estate agent refers you to, who does that on a daily basis. Like, okay, the Thomases, this is their situation. It's going to be a little tricky, and we're going to have to figure it out. Versus calling a call center and the Thomases deal being tricky, and they say, oh, you can't do it. I'll give you a prime example. I had a realtor who had talked to her client, and he had talked to his client, and she had applied with the online lender, big box online lender. They wanted her to bring 25% on an FHA loan.
That's a lot.
Right, 25% on FHA loan. I got the loan. I looked at it. I was able to get her approved with the 3.5% down. Why? Because she had reserves in her 401k. So she was going to use her 401k anyway, but why not keep that extra? And at the time, it's probably $25,000, $30,000 in your 401k and just use it as reserves. But if a person doesn't have that knowledge, they don't know.
Right.
So they could have cost her thousands and thousands of dollars that she didn't have to spend. So you like, that's where the knowledge comes in. And I've had people, who could not qualify for as much with an online lender or one of these credit unions, and they came to me and we qualified them for more because our guidelines were different. So yeah, they offered you something, but does it work? And
But
then
does
I've
it
had,
work?
does it work? So and this is the biggest thing I get, Caryn. Well, they offer me a XYZ rate. That's fine. But they told you they couldn't do the deal. I could tell you that I can
Right.
offer you 2%, but if I can't do the deal, you don't get 2% rate.
Right. Oh gosh. Well,
Yeah.
I'm very grateful that you are out there in the world helping people, because clearly you care and clearly you're knowledgeable. And it just makes me sad when people like get excited by things that aren't true. It's like, if it looks too good to be true, it probably is.
Probably is. Yep.
I really want to thank you for coming on here with me today. I could talk to you all day, but I feel like I got to let you go. I'm so glad you weren't caught in a tornado. Did you guys actually get the tornado? Did it happen?
So the tornado is coming. It's not here yet, but we've
Oh.
got a ton of rain. Like, we've got a lot of rain here. And so much rain that they send out notifications that the kids have digital learning day tomorrow and school's canceled on Friday.
Oh, dang.
Yeah.
That's a
So
lot.
I'm trying to decide if I'm going to head somewhere else and come back and see what, rather have myself be in safety. We can always get our house repaired or get a different house, but we can't get our lives back.
Oh gosh. Well, I hope that you're okay.
Yeah.
And I hope
I
that
think we will be, but when you called me when I was driving, my wife had just called and said, hey, they said you need they advise you to have 3 days worth of food on hand.
Oh my gosh.
So we'll see. We'll see how it is, but we definitely, we got food, and I've got the grill and bring it in. And if we got wood, we got charcoal. So if the electric's out, we can still cook.
Well, I'm up here in DC. We're having a little sprinkle of rain, so you can always hop in the car and come to me.
Gotcha.
I don't think we're getting any tornadoes here. We just have the political kind, but that's for another video. Thank you so much. To everyone who's watched live, thank you for hanging in there on me. I got some great friends, my YouTube clan came up, Christina and Jackie, and I really appreciate you guys supporting me. Sorry for the rough start. I was very nervous, but I do appreciate it. And if you're watching this on the replay, Kevin, where can they find you?
They can find me at Kevin Jefferson / The People's Lender on YouTube. On Instagram, you can find me at The People's Lender. And hey, listen, I don't know how many people are watching, but if you got some valuable information from this video, do us a huge favor and give Caryn a thumbs up. Also, if you are not a subscriber and you're just joining and you're just like, man, this was amazing, please subscribe to her channel. She's amazing. Her channel's amazing. Show her some love. It doesn't cost you anything to show some love.
You're sweet. You're making me blush. I can never promote myself. So thank you. It was very sweet of you. Thank you. And I'll put all of your information in the description of the video as well. And in the comments too, so everyone can find you. And hopefully we'll do this again when I'm not as nervous and I'll remember things that I actually said, because I really feel like I blacked out this whole time.
No, you did well. I heard you when you were by yourself. I was like, she doesn't even need me.
Oh no, I was happy to see you. Thank you again, and hopefully we'll do this again soon.
We will. I look forward to it. Have a great night.
Okay, bye.
Bye-bye.